In Investing 101 today, we have Juli Niemann, the Executive Vice President of Smith Moore, with us now. Julie, does the traditional 60-40 investment plan still work right now, where most investors have 60% of their money in the stock market, then 40% in bonds or other safe places?
The traditional well-balanced portfolio, no, you're going to have to be a little more defensive. You're going to have to be looking at alternatives for income because interest rates are going to continue to go up. As long as the Fed is using this tool to fight inflation, interest rates are going to continue to go up, and that makes bonds an awful place to be still.
Where would you hide money? Places with little to no risk.
CDs are starting to earn 4%, and there's no risk there. I mean, literally, you're looking at a parking place getting 4%. Money markets are still a poke in the eye with a sharp stick. And the reason you're not seeing money market rates either in banks or in the financial services industry rise much is because they don't have to. They're investing in other things and people have their money in other things. There's no pressure to raise that. That will come. But right now, a certificate of deposit, some bonds, treasury bonds, 2-year treasury bonds are looking pretty good for a return to 4%. Now, 4% doesn't meet the rate of inflation. So you are losing on purchasing power, but it is a safe place to be. That doesn't mean you move your portfolio into this. This is what you should be doing, though, with cash that has been sitting in a money market, getting a poke in the eye with a sharp stick.
Any final thoughts on the recession situation?
Every recession is characterized by real pain in the labor market. That's not going to happen this time. There is still a shortage of labor. Almost everybody is back at work who wants to work. A lot of people actually did retire and quit the job force. So a lot of those job postings that are open are going to stay open because there simply aren't enough people to fill them. Automation is going to take care of it on some of the lower end kinds of jobs. You're going to have to get used to not having service in restaurants and places. DIY, do it yourself, haul it yourself, pack it yourself, serve yourself is going to be the hallmark of virtually everything that used to have people helping you out. That's not going to be around now. But what is going to happen is that companies have worked so hard to get talented labor, they're not about to lay them off for a short-term slowdown in business. They're not going to be so profit motivated that they have to go through the agony of finding good people all over again. So I'm not looking for a big sweating in the labor market at all. And that's a huge positive why if we get a recession, it's going to be a very mild recession because you're not going to be looking at massive unemployment. You're not going to be looking at people not having sufficient wages, going on to welfare again. This is not going to be a problem this time out. It is going to be more of a super slowdown as opposed to a bona fide recession because the labor markets are still strong. And as long as labor markets are strong, people will spend. And we're seeing that now. People are still spending, they're still traveling, and their debt levels are still manageable so far. That's the one key thing to watch is how much is going on to the credit card debt. But the debt levels are manageable. So that we'll watch very closely, but that's what is going to keep this economy still moving along, albeit at a much slower pace.
The labor market is very strong. Thank you so much, Julie.
Good to be here. Thank you.
Go to businessfirstam.com for where to see our show on TV.